Good morning. My name is Sean June McCoach, and I'm the publisher of the Central Penn Business Journal and Central Penn Parent Magazine. Welcome to this installment of the Central Penn Business Journal's webinar series entitled Real Answers on Tax Reform. Today's conversation is brought to you by RKL. RKL is a leading professional services firm with roots in finance and a focus on what really matters: tangible outcomes, trusted advice, and real results that drive their clients forward. The RKL team taps into a wide range of services: tax, accounting, data analytics, performance improvement, risk mitigation, human resources, and more to deliver solutions that prepare businesses and organizations for real, sustained growth. To learn more, visit www.rklcpa.com. That's rklcpa.com. In a moment, I'll be turning the conversation over to this morning's presenters, Jonathan Clark and Eric Wenger. But first, a bit of housekeeping. All attendees are in a listen-only mode. The questions function is available if anyone has any questions throughout the conversation. Most questions we will save for the end. Our speakers will take as many questions as time permits. If a question is asked and does not get answered, it will be addressed offline via email. Today's presentation is also available for download in the handout section, and I also just emailed it out to the group so you would have it prior to the conversation. A recording of today's webinar will be made available soon after the conclusion of today's session on our website at www.cpbj.com/events. That's www.cpbj.com/events. At this time, I'm pleased to welcome today's presenters, Jonathan Clark and Eric Wenger. Jonathan Clark is a partner in RKL's Tax Services Group, providing strategic tax planning and compliance solutions to privately held businesses and their owners, including family-owned, management-owned, and private equity-owned enterprises. Eric Wenger is also a partner with RKL's Tax Services Group and the office managing partner of the firm's Lancaster office. Eric primarily advises closely held and family-owned companies in tax planning and compliance, as well as complex business issues such as mergers and acquisitions and succession planning. Thank you, Eric and Jonathan, for sharing your expertise with our audience today. If you're ready, please take it away.
All right. Well, thank you, Sean. Good morning, everyone. My name is Eric Wenger. It's a pleasure to be with you this morning. Little did we know when we scheduled this that the Eagles would win the Super Bowl and that we'd be competing head-to-head with the 11 o'clock parade. But here we are. So thank you for joining us. Obviously, the tax reform discussions have been all over the media. There's plenty of information out there, and our hope is that today's presentation will be very unique. We're not going to spend a lot of time going through the nuts and bolts of the actual law. Instead, we're going to assume that our launch point really is one where you've already read, you've already heard a lot of these general themes around tax reform. And so what we're hoping to do today is to bring you some very specific actions, answers, if you will, that you're able to apply to your individual or business situation. We're going to buzz through quite a few slides here this morning, with each of those containing an idea or two, and hopefully you'll be able to glean something from that. So starting out on our individual planning slide deck, there's a lot of areas that changed in individual taxation. I've numbered a number of bullet points here where those items change: rates, brackets, AMT changes, personal exemptions. You can read the list. We're going to touch on a number of planning actions as a result of that. And to get things started, Jonathan will lead us off.
All right, well, thank you, Eric. I guess the first big picture point that I want to make, and this is going to apply to individuals and businesses, is that in a world in which tax rates are scheduled to go down into the future in 2018, you want to make sure that you're thinking about opportunities to defer income into a year in which those tax rates are lower, and also to accelerate deductions back into the 2017 tax year while rates are still higher, because a deduction is worth a little bit more in that kind of an environment. So you're going to hear Eric and I highlight a number of things throughout this presentation that are directly related to this idea. First things first here, on the individual side of it, this is more just an awareness thing. There's not necessarily a planning action that needs to be taken here, but you may have heard that personal and dependency exemptions are now going away in 2018. So that's generally not going to be good news. The trade-off and the good news is that the child tax credit has been enhanced and expanded. And so it's been doubled from $1,000 to $2,000. But the key point to be aware of is that the phase out for taxpayers with a certain level of income has been dramatically increased, which means that in the past, You may not have been able to take advantage of this credit. Going forward now, you may be able to, so keep that in mind. Just a quick comment on kiddie tax. This is something that is applied to children with unearned passive income. The key point here is that there's been a little bit of simplification. And so in the past, you had to aggregate and look at a child's, the parents and their other siblings in order to determine the actual tax on that unearned income. Now, that income is going to be subject to tax using the trust brackets. And so it simplifies things. You don't need to aggregate as you have in the past. When it comes to individual planning, there's a couple of things that are always talked about, and the idea here is you're looking for some vehicles that you can park money into for things like retirement, healthcare, or medical expenses and education. And when it comes to retirement, the most commonly used vehicles that we see are IRAs and 401ks. And historically, the idea has been put money into a traditional IRA or 401k while you're in a higher tax bracket and basically get the deductions at that point in time. And then when you're in retirement, you're going to take that money out when you're in a lower bracket and pay less tax on it. Well, now that the tax rates are going down, the idea or the planning consideration to keep in mind is maybe it makes more sense to put money into a Roth IRA or 401k, pay tax on it now while the rates are a little bit lower, and take advantage of that. In addition to current year contributions, what you may also want to consider is money that you've already socked away into traditional 401k and IRAs. You might want to consider converting that into a Roth. And when that happens, you're going to pay tax in the year of that conversion. So the idea is, in an environment where tax rates are a little bit lower right now, that conversion may make sense. The one key point to mention when it comes to these conversions, and one of the big changes in this tax reform bill is, historically, you've had the opportunity to undo a conversion if you ever did that in the past. And so what would happen is if you made a conversion by December 31st of the year, you would have the opportunity then to kind of undo that if you discovered later after that fact that it wasn't going to be as advantageous. The ability to do that recharacterization is no longer on the table starting in 2018. So keep that in mind. When it comes to education, the most commonly used vehicle here is a 529 account. The key change to be aware of and the planning opportunity that exists here is, yes, you can put money into a 529 account and it can grow tax-free, and then when you pull it out, you don't pay tax on it as long as it's used for qualified education purposes. In Pennsylvania, you get a deduction for any contributions into a 529 plan, which is a good thing. But the key change, and this is something to potentially consider taking advantage of, is now you can use 529 money to pay for private elementary and secondary school expenses. Historically, you've only been able to use this for higher education or college expenses, but now that you can use it for elementary and secondary schooling, keep that in mind. If you're a parent, if you're a grandparent, and you have kids or grandkids that are in private schooling, you can use up to $10,000 a year per student and cover some of those tuition costs with 529 money. One of the more ironic changes in this tax reform bill is how alimony payments are handled and what the implications of that mean for marriages that are now ending and going through a divorce. And so historically, any alimony payments that were made were first deductible by the spouse that was making those payments, and then the spouse that was receiving the alimony payments did not have to pay tax on that. Going forward, one of the big changes in this tax reform bill means that ability to deduct those payments and the ability to exclude those payments from income is no longer available. And so the timing of when a divorce decree is finalized has a pretty big impact here. What the interesting thing is anybody that's in the middle of kind of a messy divorce that's been going on for a long time, they might actually have something that they agree about right now, and that's, let's get this thing done before the end of 2018, because after 2018, any divorce decree that is finalized will be subject to these new rules where you don't get the deduction and you're going to pay tax on it. So keep that in mind if you're in the middle of going through a divorce.
All right, we're going to move over to the itemized deductions section of the individual taxpayer situation, Schedule A. And just to some background here, we mentioned earlier that the previous itemized deduction qualification would apply when someone had more than $12,000 of expenses. And so once they exceeded the standard deduction, they would move into itemizing. That itemized, the standard deduction, I should say, has increased to $24,000. And so the IRS is telling us, based on their reporting, that in the past, about 31% of taxpayers were able to itemize in the past, and going forward, they're looking at 9%. So a dramatic simplification in this area, where many fewer taxpayers will be itemizing. And so we're just going to take a run through a number of items that would appear on Schedule A, starting with medical. Medical has always been something on Schedule A that's deductible. However, there was a subject to a 7.5% limitation on AGI. That 7.5% continues for both 2017 and the current year, 2018, but it's actually scheduled to move up to 10% going forward. So the opportunity here would be, are there certain medical expenses that could be paid for this year prior to that 7.5 becoming 10%? Next item, this has gotten a lot of coverage in the media. It's a state and local tax deduction. This could be income taxes, it could be real estate taxes on a primary home or a vacation home. And in the past, those items were able to be added together, and they can still be added together, but there's this new cap that's shown up. $10,000 is the maximum for a married couple, $5,000 for a single taxpayer. How do we manage this from a planning standpoint? The first question that we're asking is there some way to reclassify that property for the real estate taxes to call it a rental property? Is it an investment property? Is it being used for home office purposes for a self-employed individual? Not an employee, but for a self-employed individual. Perhaps getting it into those classes would be beneficial because there are no limitations on real estate taxes in that regard. But to the extent that it is used as a primary residence, that's going to be difficult to accomplish. For business owners that have pass-through entities, New York and New Jersey are two states that have very high taxes that are nearby, and there may be an opportunity to look at having those states in particular, if there's an S corporation, look at having them taxed as a C corporation in those states to avoid that limitation. Of course, there's other sorts of rate considerations that need to be factored into that analysis, but something to consider for the S corp shareholder who may have activities in those states. The next item here deals with the Pennsylvania pass-through businesses and a way to basically convert what would be typically state income tax expense and convert it into a charitable contribution for federal purposes. And what I'm specifically talking about here is the EITC, the Educational Improvement Tax Credit, or the OSTC program. And OSTC is Opportunity Scholarship Tax Credit Program. These are administered by Pennsylvania's Department of Community and Economic Development. And basically what it allows you to do is make a contribution to a qualified organization, and effectively that's a charitable contribution for tax purposes and not a state tax payment, but it effectively covers state taxes. Two dates that you need to be aware of that are noted on the slides. May 15th is a meaningful deadline, as is July 1st. If you're a first-time applicant in one of these programs, you're not going to be able to apply prior to July 1. If you are a repeat applicant, May 15th is the date to keep in mind. There's a huge demand for these credits, and I would only expect that that demand is going to increase. So take a look at those. Pennsylvania's new PA website has some really good information for additional details around how those programs work. Next item, dealing with charitable contributions. Overall, charitable contributions is not an area that changed as a result of tax reform by and large. In fact, the minor changes that were made were actually taxpayer friendly. However, this concept that there's going to be fewer taxpayers likely itemizing has scared a number of nonprofit organizations saying, wow, are our donations going to decline? And ultimately, is the taxpayer who's making the donation going to get the same tax benefit that they've gotten in the past? The one planning technique that we'd like to highlight in this regard, it relates to something called a donor-advised fund. And basically, those funds can be set up to allow a taxpayer to pre-fund charitable contributions to a donor-advised fund. You get a deduction at the time at which you fund your donor-advised fund. However, the money does not need to come out of the donor advised fund until until you decide to make those donations and direct them in the future. So for a taxpayer that may be sort of on the borderline about, can I itemize, can I not itemize, there may be a strategy here to look at perhaps itemizing every, say, 3 years. So that if they're on the border trying to defer certain expenses, that's difficult to do with other itemized deductions. Interest, medical, taxes, those generally appear in the year and you can't really manage around them. Charitable contributions do allow a lot more room for timing, and so the best vehicle in order to make that happen is this donor advised fund. Another quick item on charitable contributions is a planning strategy that's worked in the past and continues to make a lot of sense. Taxpayers over 70 and a half years need to pull their required minimum distributions from their retirement accounts. Having those directly contributed to a qualified charity allows them to avoid including that in their adjusted gross income. That can impact what their Medicare premiums are. It can impact other phase outs on their return. So that's a bit of a tried and true strategy that will continue to work here in this environment as well. The next big area in the itemized deduction space relates to interest deductions. The good news is for the traditional home mortgage, there's very little change. Effectively, all that happened is if a taxpayer has a mortgage of more than $750,000, they are going to be limited in how much interest they can deduct. In the past, that was $1 million. So that threshold came down just a bit. The much bigger news flash in this space is that home equity interest, by and large, is non-deductible. However, the point that we're making here says trace the use of loan proceeds to maximize your potential deductibility. If the home equity loan proceeds are still used for purposes of buying, building, or substantially improving a home, those interest costs can still be deducted. So the media has been doing a lot of coverage that says home equity loans are simply non-deductible. By and large, that is true. However, if it is still used for one of these purposes of improving or building or buying a home, there may still be a deduction opportunity. The bad news is if you're a taxpayer who's using your home equity loan for paying for college, for buying a car, for taking a vacation, those items that may have resulted in deductions in the past are no longer available starting in 2018. We should make the point too, in general, this tax reform, as much as we're talking about it here in 2018 and taxpayers are filing 2017 returns, with limited exception, primarily related to depreciation rules, there's no applicability in 17. So the 17 returns everyone's filing right now are sort of same old, same old. What's changed is 2018. Miscellaneous itemized deductions. This is the last section of Schedule A. In the past, things like unreimbursed job expenses, things like tax prep fees, investment management fees, all of those were eligible for a potential deduction. The entire section related to miscellaneous itemized deductions is now gone. And so this is something that's not taxpayer friendly, but unreimbursed employee expenses are not going to be eligible for a federal tax deduction. As a result, the question becomes, is there some way to strike a deal with an employer, or might an employer want to propose something with its employee group to alter its reimbursement for those expenses? Same story with tax prep fees. They're non-deductible on their face. The question becomes, is there a business, say a Schedule C? Is there another business entity? Is there a rental property where some portion of those professional tax preparation fees may be able to be allocated? And the last item here, casualty and theft losses, no longer deductible unless you're in a federally declared disaster area. Of course, nobody's going to wish for that, but just an item to note, if we are in a disaster area, those items still are deductible despite being miscellaneous itemized deductions. 2018 estimated taxes. So this is one that is going to be important to think about. Most people are aware of the safe harbor rule that simply said, take a look at what your prior year tax return was and base your estimates on that figure. As we move into a lower tax environment, the question is whether or not it makes sense to simply base your payments on prior year. And so spending some time doing that analysis to say, what do we really think we're going to owe in tax in 2018 based on reform will be an important question. And the other note that we make here is just that your state tax answer could be wildly different. Certain states are adopting reform, many are not, and many are in the process of trying to change their rules. So don't assume that just because something changed on the federal side of the equation that automatically results in a state tax savings as well. We're going to move into business planning opportunities and back to Jonathan.
All right, well, thank you, Eric. As many of you are well aware, there have been significant changes in the business tax area. And so just to kind of frame this a little bit and provide a little bit of context, probably the biggest thing that many of you are aware of is the corporate tax rate reduction. We're going to have a little bit of commentary on that, along with this brand new created section of the tax law, 199 Cap A, which is a pass-through deduction. We're going to unpack that a little bit. It's probably one of the most complicated areas of this new law, but we're going to highlight a couple of key things and questions that you need to be asking, things that you need to be positioning now to maximize the potential deduction that you can get there. There's a variety of other deductions and things that have changed, and we're going to highlight some, but not all of that throughout this business section. So let's jump in and talk about the C Corp tax rate. This historically had a maximum rate of 35%. It has now been permanently reduced to 21%. So this is not something that will sunset after the next 7, 8, 9, 10 years. This is permanent in the new law. So a couple of kind of action steps or things to think about here. Going back to that first slide where we started, the idea of deferring some income until 2018 or accelerating some deductions back into 2017, that absolutely applies in the C Corp context, because a deduction at 35% is worth a whole lot more than a deduction at 21%. The other thing that you'll need to keep in mind is, to the extent that you have any book versus tax temporary differences that result in a deferred tax asset or liability on your balance sheet, those things need to be revalued at the lower C Corp rate. Basically, that will be in effect when those things turn in the future. So keep in mind, that's something that will need to be done as part of your 2017 financial statements. The other thing to mention here is for fiscal year taxpayers who are going to have part of their year be in 2017 and part in calendar year 2018, there's going to be a blended rate that will apply to that. So they still will get the advantage of the lower rate that comes into play for 2018 here. If you've heard anything in the news about Apple and their huge tax liability, this next slide is exactly what it relates to. So Apple, I believe, is going to be paying $38 billion with a B in U.S. taxes on their foreign profits that they never brought back to the United States. So if you are a C corporation and you have operations overseas, hopefully they've been profitable, but if you've never brought any of those profits back to the United States, you're going to have something to deal with in 2017. And the new tax reform bill effectively deems that you are bringing all of that money back. Even if you don't actually bring it back, it's a deemed repatriation that you will be taxed on in 2017. So keep that in mind if you have any foreign subsidiaries that have been profitable and you've never brought those profits back to the U.S. The key question, or maybe the planning opportunity here, is to think about when you actually want to pay that tax liability. You have the option, you have the election to pay it all up front here in 2017 or with your 2017 returns, or you can spread that out and pay that tax liability over an 8-year period. So keep that in mind. One of the other changes in the C Corp context, and this actually also will apply to owners of pass-through businesses who pass their profits through and ultimately get taxed on their individual return, changes in NOL carrybacks. So historically, to the extent that you generated a loss, a net operating loss, you had the ability to carry that back to the 2 prior years, and to the extent that you had income in those 2 prior years, you could use your current year loss to offset that prior income and get some cash back right away. Tax reform totally changes that and eliminates the ability to do an NOL carryback. So the key point is 2017 is really your last chance to take advantage of that. If you are generating losses in 2017, you can still carry those back to 2016 or 15 to the extent you had income in those years and get some cash back at this point in time. The same thing happens in the C Corp context and on your individual return. If you have And if you're an owner of a pass-through entity that's throwing off losses that are hitting your 1040, you can do that NOL carryback here in 2017. But any losses that are generated or arise after 2017 can only be carried forward, and you can't do that NOL carryback anymore. So with that, I'm going to kick it back to Eric here, and he is going to dive into one of the most publicized and one of the most complex areas of the new law, Section 199 Cap A, and the new 20% pass-through entity deduction.
All right. Thanks, Jonathan. Yeah, this is an area that has a lot of ambiguity. I'm going to wrap up this section and share some of the open-ended questions that are unanswered. But in the meantime, let me give you a little bit of a thumbnail overview of how this is intended to work. So the pass-through deduction is really a 20% deduction for qualified business income. And this could be coming from an S-Corp, a partnership, an LLC taxed as a partnership, and it actually even applies to sole proprietorships, Schedule Cs. It applies to rental activities on Schedule E. So it has a pretty broad applicability on its face. The idea, if somebody makes $100,000 in one of these qualified activities, $20,000 of that income is simply going to be excluded, not subject to tax at all. Interestingly, it reduces taxable income, but it does not reduce AGI. When you think about the geography of a 1040, it's going to appear on page 2 of the return. So it won't reduce AGI, but it will be a deduction that reduces taxable income. For taxpayers who are married, if their income is less than $315,000, or half that amount if they're single, $157,500, then this pass-through deduction generally applies without limitation. But where it gets mighty interesting is as incomes exceed those levels, there's some thresholds that need to be met. One of them is 50% of W-2 wages paid by that entity. So it's not the wages of that particular business owner personally, it's the wages of the entity. And there's a test to say, did you pay enough payroll in order to qualify for the full 20% deduction? The other test relates to the cost of fixed assets. And this is really designed to allow real estate taxpayers to benefit from the pass-through deduction as well. Typically, real estate companies don't pay much, if anything, in terms of payroll taxes or payroll. And as a result, the first test would kick them out. The fixed asset test may allow them to still qualify, and that's by design. Congress is looking to allow real estate folks and even the individual who may have a single rental property. If it's a profitable entity, it will generate a pass-through deduction to them, subject to these other income limits. The other consideration here is a term called specified services, trades, or businesses. And so basically what's going on here is that Congress, as they drafted this, said there's particular trades and businesses that we do not want to have the benefit of this 20% deduction. Specifically, where do those qualify? Well, the fields of health, law, consulting, accounting, professional athletes, entertainers, financial and brokerage services. And here, this wonderful catch-all phrase that says, where the principal asset is the reputation or skill of one or more employees or owners. This area right here is incredibly confusing. It's difficult to think of businesses that don't rely to some extent on the skills or reputations of their employees or owners. One of the simplistic ways to look at this might be, does the business rely on you and your skills, or is it really relying more on some product that you're selling? But I think that's entirely too vanilla to really be able to make a determination here. The issue with these particular specified services is that if an individual has incomes beyond those thresholds I spoke about earlier, the $315,000 of taxable income, if they're above that and they're operating in one of these particular service type of businesses, the pass-through deduction is not allowed. And that phases out over a $100,000 band. So that's a long lead in to the slides here under 199A. Talk about what type of entity are you? Are you eligible for this? This is not a C Corp concept. This was really designed to try to level the playing field a bit with C corporations. So what's your entity structure? What industry are you in? Are you operating in real estate? Are you operating in a specified service? How much wages do you pay? That may become a limitation that impacts the business and the ability to take the deduction. Maybe it's not wage driven. Maybe it's depreciable assets. Is there much there in terms of depreciable assets that would allow the benefit? And finally, what level of taxable income? A low income taxpayer may simply be able to take the benefit, but the higher taxpayer may need to evaluate that. So from a planning standpoint, our questions become, several. There's many questions here. One of them is, how can we avoid being caught in this qualified service provider definition? I'm sure if we opened the floor for questions at the moment, there would be a whole bunch of different examples about, does this company qualify for the pass-through deduction? Because it sort of does services, but it's not, white collar lawyer services, as an example. That one's a whole lot easier to figure out. So there's questions about, what are you structured as? Another question or potential planning idea would be, to the extent that this drives off of taxable income, what can we do to reduce our taxable income and thereby free up the pass-through deduction? And so things like funding a self-employment retirement plan will reduce income. Earlier, I spoke about the donor advised fund. Maybe making charitable contributions in a given year and front-loading those would allow you to have some additional added benefit of the 199A deduction. Moving on to the following slide, wages. Are your wages set at a level that's going to allow you to benefit as much as possible from 199A? Ironically, the qualified business income for the 20% deduction is net income after you have been paid as an owner of your S corporation or after you've received your guaranteed payment as an owner of a partnership. So when you think about the math on that, to the extent that you're paying those amounts out, you're reducing your qualified business income. In turn, you're reducing your deduction that's available. And so perhaps it's worth a review of what level of wages or guaranteed payments are set up to make sure that, again, you're maximizing that deduction. Another point here is one that sort of seems a bit obvious, but I think it's worth noting. If we think about how is the IRS going to police who is or is not eligible for this 199A deduction, certainly they're going to rely on their computers and the data that they have as much as possible to automate this. And so looking at what your NAICS code is, each tax return for a business discloses the North American Industry Classification System code. If you're telling the IRS on a 17 return, on an 18 return, that you're operating in a service business, and there's ambiguity around whether or not you are in fact a service business, it's probably worth revisiting that code. And I think it would be worth revisiting that on a 17 return before that deduction becomes available to not have it necessarily coincide. And by no means are we suggesting that you represent falsely what your industry is, but if there's some gray in this, I think it's a case that you want to stay attuned to that. Another point with 199A, some folks have made the comment, well, if as an employee, I don't get this benefit, how about I just set up my own LLC and I'll provide services to my current employer as effectively an independent contractor, as a Schedule C self-employed individual. There may be some potential opportunity there, but before you go too crazy with this concept, a number of considerations. First of all, employee versus contractor, there's very defined rules about whether or not you fit the bill for being an employee or a contractor. The IRS is always biased toward you being an employee. So it's not a simple matter of just filing some paperwork and saying, voila, there we go. Now I'm a contractor. But there may be some potential planning in that space. Real estate folks, here's one for you. I mentioned earlier looking at that fixed asset cost. You may not have payroll, so you may at first believe that you're not qualified for this, but because of those fixed asset costs, you may be qualified. The last item I'd just like to mention here before we transition into the next section is this AICPA's request to the IRS, to the Treasury, to say, hey guys, we need regulations and we need them like immediately. And let me just run through a couple items that relate to 199. There's 15 specific bullets that the IRS or that the AICPA posed to the IRS. Questions around what does specific trade or service mean? That's a big one. Which businesses are in or out of that definition? What about having multiple tiered entities? How are those going to be treated? What if we have gains in one entity and losses in another? What if we have existing groupings? Can we treat a trade or business as an activity? What about a management company in lieu of payroll services? and then some questions around how to even quantify the amount of cost of fixed assets. So the point here is simply that there is a lot more guidance that needs to come. The complexity that has been introduced to the Internal Revenue Code as a result of this particular section is intense. It's a lot. And that ambiguity allows a lot of planning, but it also creates a lot of confusion. And so we're going to have to watch and respond accordingly as this year unfolds. With that, we're going to move over to Jonathan again and talk about choice of entity.
So one of the most common questions that I have gotten and that we continue to see in light of the reduction in the C Corp rate from 35% down to 21%, and in light of the new pass-through entity deduction that Eric just walked through, is what entity should I be? Should I continue to be a partnership or an S Corp, or should I convert to a C Corp? And while I would love to sit here today and give you a black and white, concrete, yes or no answer, the reality is it's really difficult to do that. There's so many considerations that factor into this decision. And so I just want to highlight a couple of those key considerations to think about and basically encourage all of you to continue to ask these questions. Ask these questions, talk to your advisors about, should I convert to a C Corp or not? Some of the considerations that we've highlighted here on the slide relate to the amount of distributions that you're making to the owners. Is there a significant amount of discretionary distributions that are being made out of your business entity to the owners? Because yes, the C Corp rate did drop from 35 to 21%. However, that second layer of tax is still there. And so any profits that are earned by the C Corp are first taxed at that 21% rate, but then any distributions that are made to the owners are subject to that second layer of tax. So that has not changed. Another consideration to keep in mind is some state implications, especially for Pennsylvania-based businesses. And in the state of Pennsylvania, the individual tax rate, or the rate that applies to income from a pass-through entity that flows through to the individual owner's 1040, is 3.07%. But the C Corp rate, especially in Pennsylvania, is 9.99%. So there's a big discrepancy there that's going to encourage Pennsylvania businesses to remain as a pass-through entity instead of converting to a C Corp. So pay attention to where you're doing business. If you're all in the state of Pennsylvania, you need to keep that state arbitrage, or that rate in the difference in the rate. Keep that in mind. Another thing is, what's your exit strategy? How long are you going to continue to own this company? And do you have a taxable exit that's coming up in the near future or not? If you do have an exit in the near future, again, in the C Corp context, you'll have that second layer of tax. In the flow-through entity context, you'll just have that first layer. And so if you step back a second and say, what considerations or what things are going to push me towards possibly converting or electing to be taxed as a C Corp versus what things are going to lend themselves or encourage me to remain as a pass-through entity, probably some of the key triggers are going to be the level of discretionary distributions that you're making. If you have the ability to keep those profits in the entity and there's not a huge incentive to pay them out, then maybe it does make sense to go the C Corp route. Whether or not there's going to be an ownership transition or a taxable exit in the near future is a huge thing. The ability to claim that pass-through entity deduction that Eric just talked about. If you're in an industry or a business that does not qualify for that deduction, it may make sense to look to convert to be a C Corp. So the reality is, you need to keep asking these questions. You need to talk to your advisors about this, and really, to do it justice, there really should be some kind of an analysis that is done to quantify and talk through all of the different options or scenarios, and basically what happens if I remain a partnership or an S Corp, or what happens if I'm a C Corp. The best way to really wrap your head around that and make the most informed decision possible is to do some analysis. So have those conversations, do that analysis. The other key thing I want to mention is the timing of this. If you ask the question, you go through and do some analysis, and you decide that yes, the C Corp is the way to go, and that's how we want to be taxed going forward. The question of timing and when you make that change is something to keep in mind here, especially as the next month is going to clip by here. So Whenever you want to revoke an S election, or if you want to make a check-the-box election to become taxed as a C Corp, in order for that to be effective, retroactive back to January 1st of 18, that's going to need to be done by March 15th, or basically within 75 days of the new year. So if you want to be a C Corp starting January 1st of 18, you're going to need to do something basically in the next month in order to make that happen. Now, the key point here is just because you think you want to be a C Corp and as a result you want it to be in effect January 1st of 18, and now we only have a month to go through this analysis, ask these questions, and make this decision, don't let that deadline rush or force you to rush into a decision that you're not totally comfortable with. Just because you don't make that election as of March 15th doesn't mean that you can't make it in April or May or June. It just means that if you do make it after that March 15th deadline, you'll have a short period where for some portion of the year you would still be an S Corp or a partnership, and then for the rest of the year after that election is made, you would be a C Corp. So keep that in mind as you consider choice of entity. The new tax reform bill had some pretty significant changes in the area of fixed assets and depreciation planning. And the long and short of it is there's a lot of good stuff here for taxpayers. The depreciation deductions have been enhanced, and the ability to write things off more quickly is available to taxpayers. So the one key question, or I guess kind of planning opportunity to just think about here is, in light of these new tax depreciation rules that allow business owners to potentially write off 100% of qualified property via 100% bonus depreciation, the expanded 179 deductions, coupled with the low unemployment rate and some of the labor shortages or the difficulty that businesses are having finding qualified workers to come and help them out, does it make sense to explore robotics or ways to further automate what you make as a business or what you do as a business? While a lot of times the costs of doing that are going to be more significant up front, the ability to write some of that off more quickly because of these accelerated depreciation provisions may warrant exploring that idea a little bit further. Another key thing to keep in mind here, especially as 2017 tax returns are being done, is the idea of a cost segregation study. And this is where, going back to where we started with that initial slide, a deduction in 2017 is going to be worth a little bit more than a deduction in 2018 when the rates drop. This is something to explore and keep in mind before 2017 tax returns are actually filed. So if you constructed a building or bought a building years ago and never did a cost segregation study or never went through that exercise to see what pieces could be carved out and accelerated depreciation could be claimed on, it's not too late to do that now. You still have the ability to go back and do a cost segregation study and file a Form 3115 with your 2017 tax return to claim the deductions that you otherwise could have gotten earlier. So keep that in mind before 2017 tax returns are filed. The other key thing for the 2017 tax year is 100% bonus depreciation. So this is one of the provisions in this bill that does not start in 2018. It actually starts for the last couple months of 2017. And what this bill said is you can claim 100% bonus depreciation on both new and used assets placed in service after September 27th of 2017. So to the extent that you had significant fixed asset additions in the last couple months of 2017, this is an opportunity to claim some of those deductions on your 2017 tax returns while the rates are a little bit higher. So keep that in mind. If you're in the M&A space and considering acquiring another company, these changes with depreciation and 100% bonus just create an even greater incentive to do an asset deal. Typically, it depends on what side of the table you're on. If you're a buyer, you're looking to acquire assets in a deal because you have the ability to get some deductions and get your investment back a little bit sooner. But if you're a seller, typically you're going to be more motivated to sell the stock of your company because you don't have any ordinary income or depreciation recapture. Well, these 100% bonus depreciation rules and some of the expanded depreciation deductions that you can now take advantage of just create an even bigger incentive for buyers to want an asset deal. So keep that in mind if you're looking to acquire another company. Last thing on depreciation. While we do have 100% bonus and we have some of these expanded depreciation provisions, the key point here is these provisions are not permanent. They are going to sunset and phase out over the next number of years. So if you take a step back and look at the big picture, and not just looking at 1 year at a time, but potentially looking at a 5 or 10-year time horizon and doing some multi-year planning, keep this in mind as we get a little bit closer to 100% bonus depreciation starting to phase out, that it might be worth electing out of that 100% bonus and not accelerating so much of the deductions up front. Because the key thing with depreciation is it's great to get the deductions up front and accelerate the deductions in the year in which you're acquiring some of these assets. It's good for cash flow, it's good for time value of money. The trade-off is those things are going to flip at some point in the future, and so you can have almost phantom income, if you will, in future years because you've already claimed all those depreciation deductions. So keep that in mind if you're doing some multi-year planning, especially as these 100% bonus rules start to phase down in future years.
All right, we're going to switch gears and talk a bit about interest expense limitations. This is a new concept. We're not used to the IRS saying, hey, business owner, you cannot deduct all your interest expense. And believe it or not, that made its way into this tax reform legislation. And so basically what's happening here is every business, regardless of their type of entity, needs to think about how much interest expense do I have and how large a number is that in comparison to my taxable income. The threshold that has been introduced is 30%. And so basically you're limited to a deduction for business interest equal to 30% of your adjusted taxable income. Adjusted taxable income is really talking about EBITDA, earnings before interest, taxes, depreciation, amortization. But this really changes the landscape a bit on, should we be borrowing money? Should we be attracting equity instead of debt to finance our business? There is a very key point in this section, and that is if your business is average gross receipts, the average gross receipts over the past 3 years, if that figure is less than $25 million, then this section does not apply. So one thing before you get too creative and start creating lots of separate entities and saying that's an easy way to beat out the IRS, you do need to aggregate. You need to look at related similar ownership entities and put them all together. So that $25 million figure is a threshold for aggregation. The other point is even a company that may say, well, you know, I don't really have that much interest expense, so the 30% will never bother me. If for some reason that company's taxable income is really down on a given year, they could find that that limitation that normally wouldn't apply ends up surprising them. So looking at how do we structure our interest expense, what do we do with our capital structure as well? And there is another piece here for certain types of businesses, and specifically businesses operating in the real estate industry. They have the option. You think about real estate, generally those deals are very highly leveraged. There is a lot of interest expense, and they may end up aggregating more than $25 million in gross receipts for a large real estate operator. There's an option to elect out of this limitation. The trade-off is that the IRS says if you do that, then your depreciation benefits can no longer be taken using accelerated depreciation, using bonus depreciation. They actually make you take ADS depreciation, which is a very slow method. And there's actually, this is a little bit nebulous, but our belief is, based on what we're reading and understanding from commentators, is that that ADS depreciation applies to all assets, not just that year's addition. So there's definitely some analysis that would need to be done before somebody determines that it's more beneficial to elect this route out of the interest limitation. Changing to another subject, accounting methods. This is something that could be significant for a number of taxpayers that are on the phone today. In the past, small business taxpayers have been able to use the cash method of accounting, but it didn't take a very large business before they were precluded from it, or if they had inventory, cash basis was simply off the table. And the IRS, through this tax reform legislation, has actually opened up that opportunity and now allows many more taxpayers to potentially go on cash basis. That $25 million average gross receipts figure that I talked about previously related to interest, that same $25 million figure applies in this context. So looking at, for example, 17, 16, and 15, what are your average gross receipts? Again, aggregating related parties. If you're below 25 million, you may have the opportunity to switch from accrual basis to cash. Why would I want to do that? What does that do for me? If a business has a lot more receivables and other current assets than what they have accounts payable or other current liabilities, basically what it means is they're funding their operations. They have a lot more money tied up in their accounts receivable, and they haven't yet received that cash. By definition, when you convert from accrual to cash basis, you're able to make that adjustment. And so it could end up having a very significant impact on taxable income in a favorable way. And obviously, if it's unfavorable, you don't need to make the change. So this is a nice one to look at. And there's actually some additional changes as well related to UNICAP, for small taxpayers being able to elect out of doing the uniform capitalization rules, percentage of completion for the construction industry. A lot of complexity in this area as well, but just keep this in mind that it could be a very significant tax benefit to potentially change to cash basis. Wanted to touch briefly on a few tax credits. There were certain proposals during the tax reform debate that would have either limited or taken away some of these credits, but ultimately what passed has allowed us to retain the R&D tax credit, which is a huge tax benefit for certain industries and taxpayers. Tip credit for those in the restaurant industry, and WOTC, work opportunity tax credits. All of those have survived and exist. And when you think about it, generally with credits, you're swapping out a tax deduction or a tax credit. When the rates have gone down, as they have here in 2018, deductions are worth less as a result. So credits become proportionately worth even that much more. And so just a reminder to make sure that you're on the lookout for R&D credits, for tip credits in the restaurant industry, for WOTC credits if you're hiring in certain specific groups, folks coming off of social programs, former convicts. There's a number of different definitions that would qualify there. Another point I'll just make here as far as things that did not change, capital gains. We didn't really talk at all about investment income, but capital gains rates are effectively unchanged. The net investment income taxes, sometimes called the Obamacare taxes that were introduced a number of years ago, those are also unchanged. So keep those in mind. They still exist, no real changes. And one other quick one there is entertainment expenses are no longer deductible. They used to be deductible 50%. So you go to a ball game, you go buy recreation amusement tickets to any variety of event for business purposes, you can still write off half of that cost. Now, regardless of type of entity, those are non-deductible. One of our final slides here, what should I do now? And so this is really just a recap. What do you need to know today? Hopefully we gave you a number of gems to jot down and think about how it impacts your personal or business situation. The first point being what we led off with. 2017 deductions are worth more than 2018 deductions. And so what can you possibly do in order to maximize those 2017 amounts? That could be depreciation related. It could be paying pension contributions and bonuses, looking at how you do self-insured IBNR reserves, incurred but not reported. There's a lot of opportunities to try to drive the 2017 taxable income as low as possible. You might even be able to drive it as low to create a loss. And as Jonathan said earlier, we're able to carry back 17 losses, but we cannot carry back future losses. So this is a bit of a one-time window to grab and get a refund of taxes that were paid in either 15 or 16. The choice of entity discussion that Jonathan led, maybe it's time to take a look at that and do some analysis that may or may not make sense to change your entity structure. Being able to claim depreciation deductions that were otherwise missed. Sometimes folks will say, well, it's just a timing difference, so I'll get my deduction anyway. This right now, during this year, is a very unique window to actually get a deduction that will be worth a lot more this year, and that opportunity goes away after filing your 17 return. It may mean that you want to extend your 17 return to make sure that you're claiming every possible deduction and write-off possible. Accounting method changes, we talked about cash method, don't forget that opportunity and a number of related planning opportunities. and estimated payments. Don't just blindly pay safe harbor estimates. That may not be the right answer given the new change in tax legislation. We are running tight on time. Our thought is that we have a lot of resources on our website, rklcpa.com/tax reform. There's a lot of information there, some highlights of today's presentation, some video, some handout resources, and there's also a place on that particular landing page where you will be able to submit a question. And we would welcome any questions. I know there's a few that have come in here during the webinar. Given our time constraints, what will probably work best for us is if you'd like to hop to that website, rklcpa.com/tax reform, simply fill out that question on that page, and someone on our team will be able to get back with you and provide a response. Again, we hope that this was a worthwhile exercise. We hope that you found some gems in here that you'll be able to apply to your situation. There's a lot of complexity. We did a very quick flyover of a lot of different law, and we realized we didn't give a lot of specifics on the exact rules, but we'd encourage you to reach out to us. If there's any questions that you have, you're welcome to let us know. With that, I'll turn it back over to Sean, and if you'd like to bring us home.
That sounds great. Thanks, Eric. Thanks, Jonathan, very much for your time and your expertise. Thanks to everyone at RKL for lending your insights into this very important topic. There are many questions in queue. Thank you to everyone who has asked a question. I will make sure that today's presenters receive all of your questions so they are able to respond offline. I hope that everyone on the line has enjoyed this time as much as I have and has 2 or 3 takeaways that you can implement immediately at your places of business. Thanks again to everybody who asked questions. Thanks again to Jonathan and Eric. This will end today's call, and I hope everyone has a great rest of their day.